This is time sensitive. The gold to silver ratio just hit a level it hasn't been at in 30 years. And if you're not paying attention to what that number historically signals about the relationship between these two metals, you're going to miss one of the clearest setups that precious metals markets have produced in 3 decades. This isn't a technical indicator buried in a chart that only professional traders look at. This is a simple ratio. How many ounces of silver does it take to buy 1 ounce of gold? And right now, that number is at an extreme that every single time in the last 30 years it's reached this level has preceded a significant outperformance from silver relative to gold. Every time. Not most times. Every time. So I'm recording this right now because if this pattern holds, what comes next for silver could be one of the more significant moves this market has produced in a generation. I'm recording this right now from Los Angeles, and I want you to comment what day and date you're watching from, because this story moves fast and the timeline matters. And real quick, if you value calm numbers first breakdowns that cut through the noise and focus on what the data actually says, do me a favor, subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now here's the claim making the rounds. The gold-silver ratio is at an extreme. It hasn't been this high in 30 years. Historically, when it hits this level, silver outperforms. And on the surface, it sounds clean. Simple ratio, historical pattern, obvious trade. But when you slow it down piece by piece, you realize there's more nuance here than the meme version suggests. The ratio can stay extreme longer than you expect. The silver outperformance, when it comes, is not smooth. It's violent and fast and full of fake-outs. And the historical pattern, while real, is not a guarantee. It's a tendency. And understanding the difference between a tendency and a certainty is what separates people who make money from this setup from people who get wrecked trying to trade it. So I'm going to break down 3 things. First, what the gold-silver ratio actually is, what it measures, why it matters, and what the 30-year extreme actually looks like when you put it in context. Second, what has historically happened after the ratio hit these extreme levels, not just the direction, but the timing and the volatility. And third, what you actually do with this information if you're an investor, a trader, or someone just trying to understand what these two metals are telling you about the broader market. So let's start with what we can verify. The gold-silver ratio, as I'm recording this, is sitting at a level that places it in the top 5% of its historical range over the last 30 years. That means silver is historically cheap relative to gold, or alternatively, gold is historically expensive relative to silver. Here's the clean way to think about it. If you're holding gold and the ratio is at an extreme, you can sell 1 ounce of gold and buy a historically large number of ounces of silver. If the ratio then normalizes, meaning if it moves back toward its long-term average, your silver position in gold terms becomes worth significantly more. The ratio is not a price call. It's a relative value call. It's saying that one of these metals is out of line with where it historically trades relative to the other. Now, what's the long-term average? Over the last century, the gold-silver ratio has averaged somewhere in the 50 to 60 range. That means, on average, it takes about 55 ounces of silver to buy 1 ounce of gold. When the ratio goes to 80, 90, or beyond, silver is cheap relative to history. When it drops to 30 or below, gold is cheap relative to history. Right now, we're at a level that says silver is historically undervalued relative to gold. Not by a little, by a lot. And the 30-year extreme framing is important because it tells you this isn't just a normal fluctuation. This is at the outer boundary of the range. These are the moments that when you look back at charts years later, you circle and say, that was the setup. Here's where the historical pattern gets interesting. Every time in the last 3 decades the ratio has reached these extreme levels, silver has eventually outperformed gold significantly on the way back to normalization. Now, the word eventually is doing a lot of work in that sentence, because eventually might mean 3 months, or it might mean 18 months. And in the meantime, the ratio can go even more extreme before it reverses. That's happened before. The ratio hit extreme levels and then got more extreme before silver finally made its move. And anyone who was leveraged trying to play the ratio trade got liquidated in the process, even though the eventual outcome proved their thesis correct. That's the most common way this trade destroys people. Not being wrong about the direction, being right about the direction but wrong about the timing, and using leverage that doesn't survive the wait. Now let's talk about what actually causes the ratio to normalize. It's not magic. It's not just mean reversion for the sake of it. There are specific conditions that cause silver to outperform gold. First, industrial demand acceleration. When global manufacturing picks up, when infrastructure spending increases, when solar and EV production scales rapidly, silver demand increases faster than gold demand because silver has those industrial applications and gold doesn't. That demand forces silver's price up faster than gold's, which compresses the ratio. Second, investment demand rotation. When investors who already own gold start looking for more leverage to the same macro themes, silver becomes the vehicle. It moves faster in both directions, and in a bull market, that speed to the upside is attractive. That rotation from gold to silver compresses the ratio. Third, supply shocks. If primary silver production gets disrupted, if major mining operations slow down, the physical market tightens and the price responds faster than gold because the silver market is smaller and less liquid. That also compresses the ratio. Right now, as I'm recording this, you've got elements of all three in play. Industrial demand is structurally elevated. Investment demand has already begun rotating from gold into silver. And supply is not expanding fast enough to meet the combined industrial and investment demand. That combination is exactly the cocktail that has historically triggered ratio normalization. That's not a coincidence. That's a mechanism. Here's a question for you. If the ratio normalizes from its current extreme back to its 55-year average, and gold stays flat while silver does all the moving, what does that tell you about where silver needs to go? Work out the math and drop it in the comments, because I want to see how people are framing this. Now here's the skeptical alternative. Could the ratio stay at current extreme levels indefinitely? Could something have changed structurally that makes the historical pattern less reliable? Yes, it's possible. Here's the scenario. If gold continues to be aggressively accumulated by central banks while silver's industrial demand growth slows because of a global recession, the ratio could stay wide or go even wider. If investors treat gold as the monetary metal and silver as just an industrial commodity, the monetary premium stays in gold and doesn't spill over into silver. That's plausible. Here's how it fails. The current industrial demand for silver is not discretionary the way consumer electronics demand was in earlier cycles. Solar installations have multi-year government mandates behind them. Grid upgrades are legally required in most developed countries. EV production targets are embedded in policy. That demand doesn't stop because sentiment shifts. So even in a risk-off environment, the industrial floor under silver stays in place, and that floor is what eventually forces the ratio to normalize. And I'm going to say something that might annoy both sides. The ratio can be at a 30-year extreme and still not move for another 6 months. Same data, different interpretation depending on your time frame. If you're a short-term trader, an extreme ratio reading with no immediate catalyst is a frustrating slow bleed of theta on your options or a margin call waiting to happen on your futures. If you're a long-term investor, the same extreme reading is a setup that you size into and hold, knowing the normalization is coming, but not knowing exactly when. Those two approaches live in completely different worlds. And the biggest mistake people make is trying to apply long-term thesis logic to short-term position sizing. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1. The ratio normalizes gradually. Silver slowly outperforms gold over the next 12 to 18 months. Not parabolic, just steady. Every month, a little bit of ground gained. Gold goes up 10%, silver goes up 15%. Gold goes up 5%, silver goes up 12%. Over time, the ratio compresses from its extreme to something closer to historical norms. That's not exciting. That's not viral. But it's how real wealth is built in precious metals, through patience and sizing, not through leverage and timing. Path 2. The ratio normalizes violently. Silver goes from current levels to 200, 250, 300 in a compressed period driven by a combination of supply shock, demand surge, and investment FOMO. The ratio doesn't grind back to normal. It overshoots in the other direction. Silver goes from historically cheap relative to gold to historically expensive relative to gold, and the people who sized in early and held through the volatility make life-changing returns. That has happened before. It happened in the late 70s. It happened in 2011. It can happen again. I'm not predicting it. I'm saying it's within the set of things this market is capable of doing. Here's what to watch. First, watch the ratio itself weekly. If it starts compressing, if it goes from current extreme levels to something 5 or 10 points lower, that's the early signal that silver is beginning to outperform. If it stays flat or widens, the setup hasn't triggered yet. Second, watch silver's relative performance on up days in precious metals. If gold is up 2% and silver is up 4 or 5, that's silver accelerating. If they move in lockstep, the rotation hasn't started. Third, watch industrial demand signals, specifically solar installation data and EV production numbers, because those are the pipeline for structural silver consumption that supports the thesis beyond just investment demand. And fourth, watch whether the mainstream financial press starts covering the ratio. When CNBC and Bloomberg start doing segments on the gold-silver ratio extreme, that's usually a sign that the retail wave is about to arrive, which is both a tailwind and a timing signal that the move might be closer to exhaustion than inception. So what do you actually do with this information? Here's a simple action plan. No drama. Step 1. Decide whether this is a trading thesis or an investment thesis for you. If you're trading it, keep it small, define your entry and your exit, and set a stop that you'll actually honor. If you're investing it, size it appropriately for a position you can hold for 1 to 2 years without checking every day. Step 2. Consider a gold to silver swap. If you own gold and you're comfortable with more volatility, rotating some of your gold exposure into silver captures the ratio trade without adding net precious metals risk. You're just repositioning within the asset class. Step 3. If you're adding new silver exposure, do it in layers. Don't put everything in at once. Add some now, set levels where you'll add more if it pulls back, and let yourself scale in over time. Step 4. Don't use leverage. The ratio can get more extreme before it normalizes. Leverage doesn't survive the weight. The trade works without leverage if you're right. Leverage just adds the risk of getting eliminated before the thesis plays out. Now, here are my questions for you. Do you think the ratio normalizes in the next 6 months, or does it stay extreme into next year? And are you positioned in silver relative to gold right now, or are you all in one or the other? Drop your answer below and remember to include what day and date you're watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want to follow up when the ratio starts moving. And if this helped you, share it with someone who owns gold but hasn't looked at the relative value case for silver yet. All right, stay sharp, and I'll talk to you soon. And just so we're crystal clear, this is educational content. It's my take based on publicly discussed information and my own reasoning, and it's not personal financial advice. I'm not your advisor. I don't know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation, and if you need personal advice, get it from a qualified professional who knows your situation.